Welcome, everyone, and thank you for joining the CFA Society Switzerland's webinar on ESG Investing Amplified, the COVID-19 Reset. Please use the Q&A symbol to ask questions. After the presentation, these questions will be discussed. Many thanks to our Swiss Pensions Conference sponsor, Goldman Sachs Asset Management. Today's speakers have special insight into how the COVID crisis and ESG investments affect investment portfolios. Our speakers are Niamh Whooley and Luc Bars. Niamh is Executive Director, Head of ESG Research, Fixed Income. Niamh works across global Goldman Sachs Asset Management Fixed Income in a role centered on understanding how sustainability intersects with fundamentals. Niamh has a deep background in ESG investing, having worked in the related roles since 2005. Luc is Head of Fundamental Equity Client Portfolio Management in EMEA for Goldman Sachs Asset Management. He coordinates the strategy, business expansion, and client communication efforts for the fundamental equity business. He helps lead fundamental equities thematic, impact-oriented, and ESG investment effort. Welcome, Niamh and Luc.
Thank you, Sheila. And thank you so much for having us today. It really is a pleasure for Niamh and I to join you. As Sheila mentioned, we both sit within the respective fixed income and equity businesses within Goldman Sachs Asset Management. And so what we really wanted to do today over the course of the next 45 minutes or so was try to give you a little bit more color on what we think, what we do, and how we approach the challenge of ESG integration into our various portfolios. And as Sheila mentioned, also then just give a little bit of perspective from our side as to how that landscape is changing in a post-COVID-19 world. Because clearly a lot of the considerations that have been fairly focal within our investment decision-making processes have become a much more elevated in the broader awareness of investors and the industry as a whole. And we need to reflect on how that potentially impacts performance and risk of our strategies going forwards. Maybe just then as a starting point, and Mariana, if you could just jump to the first slide, what we wanted to do here was to provide a little bit of broader context just on GSAM and our approach to ESG and impact investing. Now, you can see on this first slide that within Goldman Sachs Asset Management, what we have sought to build are investment-driven and investor team-led ESG integration processes. Now, effectively what I mean by that is that as equity or fixed income investors, there's always been a necessity to focus on the ESG considerations within our investment decision-making process. As an equity investor, you're effectively buying into the long-term cash flows that business can generate. And so understanding the sustainability of practice and how that could impact risk and return for those businesses going forwards is always a critical consideration. On the fixed income side, as Niamh will articulate in a second, there's an absolute necessity to understand the strength of balance sheet, and clearly that is also impacted by the strength of practice within those different businesses and across that credit landscape. And so we've tried to leverage the experience of understanding of our 200 plus investment research teams globally to recognize what are the material factors that we need to consider and how should we build that framework for lasting success. There's absolutely a recognition within that the availability of information, the access to data across a lot of these different KPIs has increased, and we have to factor that into the frameworks that we utilize. But the core premise here is that as fundamental bottom-up investors on the equity or on the credit side, we need to be conscious of those practices and factors that can impact the broader success long-term of these companies and build that from an investor-led perspective. Now, what we also benefit from, I think, within Goldman is the fact that there is a lot of different resource that we can tap into. So there are at this point now more than 40 people working specifically on ESG and impact related aspects of our business. A lot of those will be focused on things like data, both in terms of procurement of data, but also improving the quality of the data we have access to. And so different initiatives like your ability to better understand scope 3 emissions, both upstream and downstream, can actually factor quite heavily into how you then make that fundamental investment decision. Being able to go beyond just the readily available scope 1 and scope 2 emissions data to get a better perspective of what is the true carbon intensity of that business actually can be very useful as you form your overall qualitative understanding of that company. And then I think the final part of this is that it factors heavily into then how we think about stewardship and engagement. We have a dedicated stewardship team that works very closely with all of our investment teams. At this stage, we vote on roughly $300 billion of equities globally, and that gives us a very powerful footprint in the industry in terms of our ability to drive change across the companies we're invested in, and our ability to then leverage that expertise across our broader credit portfolios as well. So we're making sure we're engaging not just on the equity side, but also on the fixed income side, where frankly, as companies look to refinance, and you can make those engagement efforts very clear to them and actually drive changes in cost of capital quite effectively over the short term, that is something that we think is a crucial long-term driver of our success. So that's just very big picture how we think about the ESG and the impact space. And I just want to go on to a couple of additional points related to this. So if we jump to the following slide, what we wanted to frame at the outset here is just why ESG matters. And I know a lot of this is quite obvious to people because now you have an increased awareness and understanding within the industry, but I think sometimes it's helpful just to take a step back and understand the practicalities of why this is such a crucial part of any long-term investment approach. Now, within this, what we're trying to say here is that value creation, either through growth of a business or through increased balance sheet strength that by association comes from sustainability of practice and the associated growth that can bring, can drive superior performance. It's not that there's one obvious mechanism that flows through, but we have seen through our research that improvements in environmental practice, so your ability to manage the energy usage within your business, the ability to reduce the resource intensity or carbon intensity of your business, or on the social side of things, the ability to improve labor practice, supply chain management, has a meaningful impact on your ability to drive lower cost of capital and increase sustainability of returns. And when you think about this from the perspective of a bottom-up investor, you actually accept within your decision-making process that you can't predict those short-term catalysts that might cause companies to re-rate, i.e. what are those exogenous macro factors that might cause a company to re-rate in the short term? You accept that that's not part of your core discipline. And so implicitly what you're saying when you buy into a stock or buy into a credit is I have a view that over the longer term, this is a business that can reward me either through the creation of value and the flow of value down to me as a minority shareholder, or through the resiliency in their balance sheet that ensures that credit stays credit worthy. And just looking then on slide 5, what you can see just quantitatively is some of these are now increasingly apparent when you try and run some type of analysis across the broader industry landscape. So you can see that if you take the top right-hand chart, very apparent that the funding costs of companies with better ESG credentials have come down quite significantly versus those with weaker ESG credentials. It's not that that wasn't always a trend that we saw across the industry. Clearly, going back even 10 or 15 years, companies with very poor practice would always have suffered from higher funding costs, but the spread between those that are doing a really strong job of improving practice and really driving positive change across this ESG space are being rewarded disproportionately well relative to those that are clearly laggards within this context. And what you're also seeing, and it's shown quite clearly on the bottom right-hand side, is the industry's and investors' willingness to look through ESG issues has materially diminished. Where you do see controversies, where you do see challenges, the market reaction to those is as severe as it's ever been. And I think that's important for us to consider as investors because, of course, ESG is about risk mitigation. It is about understanding the challenges that companies could face if they are unable to sustain practice internally, or if they're unable to move towards a world that has a greater focus on ESG characteristics. But there's also within that some aspect around the opportunity that this can find for us. And so if you look at the bottom left-hand chart, you can see that as well as thinking about this as avoidance of risk and lower funding cost, actually what you can also find is those companies that can improve some of these practices. And in this instance, looking at the sentiment from employees and how companies do when they have higher conviction from their employees in the broader business, you can see that's very closely aligned to superior performance. So there's a pretty good proof statement here around the importance of ESG, not just qualitatively, as we've said, very much tied into the sustainability of returns and tied into the ability for companies to sustain lower funding costs, but actually also, as you can see, increased quantitative evidence that this does factor through into better risk-adjusted returns for investors. Now, the final point I'd make here before I turn to Niamh, and it's just what we have shown on slide 6, is as much as all of that is true, it doesn't make ESG assessment an easy discipline. And I think this is where we have taken a very strong view and tried to articulate this across our clients, because as much as we recognize the importance of ESG, we would also push back aggressively on the idea that it can be simply quantitatively determined whether a company is good or bad. And part of the issues you have there is a lack of high quality data still across the industry. The way to solve for that is to spend a significant amount of time as investors going out to companies, engaging with them and trying to understand what it is that's actually happening in practice, but that is inherently very labor intensive and resource intensive. And so the way we try to frame this argument to our clients is, well, let's just think about the parallels between credit rating agencies and ESG vendors who are providing ratings on companies. If you looked at Moody's, Fitch, S&P, you'd find that the correlation in their ratings across credits would be somewhere in the 0.95 to even 0.99 range, depending on the point in time. Now, that's not to say we can't critique the rating that any of those individual rating agencies is providing, but what it's to say is that there's some underlying academic discipline that we universally accept can be applied to draw conclusion on how creditworthy a company may be. What you see, and it's shown here on the charts on the bottom right-hand side of slide 6, is that when it comes to ESG, actually you get a very wide range in outcomes. If you just look at MSCI, Sustainalytics, Thomson Reuters, typically the correlation in outcomes for those 3 rating providers will be somewhere in the 0.5 to 0.6 range. Now, what that's saying to us is not that one of them has definitively solved that issue, but that there are a multitude of challenges in taking non-numeric, non-standardized, and often estimated data and trying to put that into a quantitative framework that can delineate down to what is a good company and a bad company. There are absolutely principles that we all agree to around materiality that Niamh will touch on in a second, but when you try and take that information and try and quantify it down into a rating, you do have some quite obvious challenges that we think can be rectified by applying qualitative judgment of our analyst team. So when I started right at the outset by saying we've built investment-led ESG investment philosophies, what I mean by that is we recognize the pitfalls and challenges that still exist within the space, the fact that data is still flawed, inherently backward-looking, and does therefore need a qualitative judgment-based approach, and hence have empowered our analysts within that assessment framework to come to the right conclusion, leveraging the information that we can put at their disposal. So hopefully that's useful just by way of introduction. What I'll do is pass to Niamh, who can just touch a little bit more on our integration approach across our various investment teams, and then we'll try to spend a little bit more time on the technology and engagement efforts that we have across our business.
Thank you, Luke. Just to reiterate again that I'm going to take you through our process in terms of integrating ESG, but just to remind you that the basis of our activity and our efforts in terms of ESG is to basically train and leverage off our investment team's knowledge of their coverage and give them the tools, the metrics and the frameworks to embed ESG in their analysis. So we don't want a siloed ESG team doing great work in terms of analysis. It's very much about getting our analysts to take it down to their coverage level. So if we turn to page 8, the next slide, then yes, great. Just the first starting point with our analysts is that, you know, companies report on a lot of factors, and in fact this has increased significantly since 2009. but we really want to focus our analysts on what's material for their sector. So for a telco analyst, for example, on the social factors, we would say that data privacy and cybersecurity is a key risk for that sector. So it's focusing on what can impact performance. And what we're showing here on slide 8, on the top part, is in relation to equities, where it was shown that when you focus on the wider range of issues across a whole range of kind of data points, there was no outperformance in terms of ESG, whereas it has been demonstrated when you narrow it to what can impact the kind of the fundamentals, credit risk, or share price. In terms of fixed income, which is where I'm based, there are less studies done in terms of kind of materiality, ESG, and performance. Probably the one that is most frequently cited is Barclays 2016 and 18, where again, they showed that basically ESG performance, that there was lower, high ESG performance, lower incidence of downgrades by credit rating agencies. In the first instance in 2016, it related most closely associated with governance, and when they did the follow-up study, it was actually in terms of environment. So turning to page 9, you'll see in terms of our materiality framework, our starting point was this matrix of both themes and issues, because we want basically our analysts to become very familiar with the themes and how to measure those, whether it's health and safety or whether it's conduct risk. So you'll see here in terms of the ESG, we broke it down into key themes like climate change, the issues underlying those themes, and apply them across our different sectors in terms of, for example, banks would have a higher weight of governance, whereas you would expect, for example, natural resource companies to have higher environmental, and for example, pharmaceutical companies, actually the key risk is within the social factors. So it's under our issue product safety and quality. So this ranges from opioid litigation to US drug pricing. We saw in the last election that price gouging became a key election issue, and also things like FDA warning letters in relation to pharmaceutical manufacturing. So we work with our analysts on these themes, on the data points, and we're constantly focused on the best source of data to input this and to help them with their analysis. I would make one point in relation to what I have seen in terms of equities versus fixed income is that, and Luke mentioned this, that obviously the risk in relation to ESG issues is key, but I would say even more so for bondholders, where we're primarily focused on downside risk that could impact an issuer's ability to repay its debt. Now, equities, of course, also looks at tail risk, but also can look at sustainability solutions. So there's more upside. So you'll see within this, for example, things like product positive impact. We do look at that within credit, but within equities, it's things like access to finance, access to medicine, and the sustainability solutions that exist there. So this is our materiality matrix, and I'll just show you the process, turning to the next slide. You'll see here our rating process, and again, this is undertaken by the analyst. So on the left-hand side, you'll see our ESG data points. We have ensured that our materiality matrix is aligned with all available standards in the market. Now, Luke mentioned in terms of the quality of data, one movement in the market is towards agreement on what is material and what companies should be reporting on. So TCFD is the basically task force for climate related disclosure. We look at SASB, which is the sustainability accounting standards, and also we ensure when we did our materiality matrix that it was aligned to the EU taxonomy. We then further do deep dives in areas such as climate. During COVID, we actually looked quite closely in relation to companies' activity in relation to buybacks. and we also focus on the social, which is a Goldman Sachs engagement theme, what we call inclusive growth. And I will come to the social factors later in the presentation. I would say that direct engagement is probably one of the most important parts of the process, because Luke mentioned that data is backward looking, and that we try to overlay this with the analyst judgment, having given them the tools and the metrics. We basically, it is upon the analyst to assess, and they do that by direct engagement with management teams. And this is all about forward-looking performance. So the example that I always give in relation to this is, for example, there's a US bank that has had a number of conduct issues, specifically in relation to fake bank accounts. A lot of the ESG data providers are still kind of rating that bank in relation to that. But for example, our analyst who covers financials met with the new management team in Q4 2019 and would, from direct engagement, would have a more positive view on performance going forward and what they're doing to rectify past issues, lessons learned, and putting risk frameworks in place in relation to conduct. So those are our tools, our data and our metrics. You'll see to the right-hand side, this is our rating framework that we have built within our technology platform. And what we do is we break it down by the ESG, the themes, the issues, and just within that, the analysts identify who they think is the leader within their coverage, who's the laggard, and then in line with peers, better than peers, or weaker than peers. So it's always relative, where it's not, you know, between sectors, it's relative to sector peers. And as I say to all the analysts when they're undertaking this, you can always rank in terms of your views on performance on key themes. And the momentum to the right-hand side, this is where we capture through the engagement, the analyst's view about the future strategy. It could be on something like climate transition in relation to utilities. And this basically increases the score, or basically it makes the score go lower. So you'll see that they put improving, stable, or deteriorating, which is the analyst's view that is reflected in our rating. So
Mariana, sorry, do you mind just turning forward to page 11? Because just what Niamh was talking to is shown here quite clearly across the page 11 slide.
Yes, thank you. So what you'll see here is we have built this within the platform, and you'll see here, this is for credit because that's where I'm based. We also have this within equities, but you'll see that we're also capturing engagement, and that includes both shareholder engagement, but also we're undertaking bondholder engagement. You know, there's the capability of showing the MSCI rating. So we do have a third-party data feed into this, but you'll see here that this is for a utility company, whereby we have identified that the material themes are the environmental things like the climate transition, water, and others. Governance is obviously, particularly for bondholders, a key component across all of our coverage. And you'll see the weights in relation to utilities on the right-hand side in terms of the ESG. And this would look very different for other sectors, obviously. And it's all about working with the analysts to basically all the time kind of get granularity and understanding and tools and metrics in relation to these themes. So this is built within our platform, and within all of our coverage, there is basically, we have it set up to undertake the ESG rating. So turning to page 12. You'll see here again, just this is live in practice, that this was in relation to REITs. And I think why it's important, and Luke stressed this as well in terms of capturing the analyst view and their level of knowledge of their coverage, was that we, you know, in this instance, a third-party data provider had a negative view in relation to this European REIT, primarily to do with their environmental performance and also in relation to governance. Whereas we actually had a positive view on ESG in relation to this REIT for two reasons. The first is we felt in relation to the environmental framework that was evaluated in relation to this REIT, it kind of was looking at a commercial property holding, whereas this is actually residential, a residential REIT. And it was looking at international standards that are typically applied within commercial portfolios. Whereas from engaging with the management team, our analyst was aware that this REIT was basically buying older buildings within their portfolio with the view to fully modernizing them. They have specific targets to undertake refurbishment of 5 to 7% of their property, and they actually have targets, which is always what we're looking for in relation to ESG, out to 2025 to reduce their carbon intensity. But particularly importantly from a bondholder perspective is that the third-party rating providers often consider governance from an equities perspective, so from a shareholder's perspective. So in this instance, they had a negative view from the shareholder perspective, but our coverage analyst had a positive view because he felt that the management team were not incentivized into taking unnecessary risks with the profits going for charitable purposes. So this is an instance where, again, you know, where we very specifically apply our framework to the asset class, and a shareholder can often have a different view in relation to governance as compared to a bondholder. So turning to the next slide, just to briefly highlight our technology platforms, because I do think this is one of our competitive advantages, is that we were able to basically inbuild within our existing platform an ESG framework across all of our coverage. It includes our rating process, which is visible and readily available to the analysts, but visible to all of the investment teams. We also record within this proxy voting and other engagement activity. So for example, if we, you know, if we're looking at in relation to an issuer, I can look across in terms of equities and see when the last stewardship meeting was with that issuer and that company, and in relation to the notes that were taken on material issues. So all of this has been built out across all of the platform, including equities. I guess within fixed income, just to highlight again that we have applied a very similar process to our sovereigns, securitized munis, and other segments of the bond market. And it's all about kind of a shared process without necessarily having a shared outcome, which recognizes the different asset classes. So with that, I'll hand back to Luke.
Thanks, Niamh. I just think to reiterate that point, if your starting point is that you want to leverage the insight that data can provide to you, but you want to trust the qualitative understanding of the analysts who are closest to those companies, and for us, that is a global footprint team with a lot of local awareness and presence, then building that ESG assessment framework and that engagement framework into your core ecosystem has been a critical part of how we've evolved the process internally. Making sure analysts have access to all of this information, that it can feed through into their thought process, but not trying to overlay an ESG view that would be contradictory to their fundamental perspective. And I think the other area, and maybe just turning to slide 15 here for a second, the other area that we've really started to emphasize in terms of the build out of our technology and system capabilities is the relevancy of certain ESG characteristics from a risk management standpoint. So for example, carbon intensity, which we accept as a very critical risk management factor in so much as the cost of carbon is increasingly rising, in so much as investors are putting a much more critical focus on companies with unsustainable carbon intensive processes. What we've also sought to do is really embed this into our risk management framework. So you can see on the right hand side our standard daily risk reporting. So this is what all of our portfolio management teams would receive on a daily basis, that would break down the risk in their portfolio through the lens of non-stock and stock specific risk, and then across a variety of different style factors as well as individual stock level positions. What you can also see within that is a breakdown within the portfolio through the lens of carbon intensity. So understanding how the portfolio compares to benchmark through that lens of carbon intensity, both in terms of sector allocation and stock selection, and then also understanding where the most significant component of the portfolio's carbon intensity is coming from at a company level. Now, the relevancy for that is not that we're automatically going to be forced to change portfolios, because again, many instances, carbon intensity data is a little bit skewed by either estimations that are taken. Only at this point, 20% of companies globally actually disclose their carbon footprint. So for the other 80%, we're really having to base that on estimation. So we don't want to be governed by that, but also that in many cases, it is backward looking. And so if an analyst has a view on a company that they're doing the right thing to improve their carbon intensity, actually that might be something we're willing to look through in the short term, but at least having a framework that flags that up to us and can highlight where those potential issues are is very critical. It also feeds very closely into our engagement activities, because what this can allow us to do, and it's shown somewhat on the left-hand side here through our portfolio construction tool, is on a real-time basis, recognize where the carbon intensity is coming from within the portfolio and ensure we have a very good perspective, especially around those more carbon intensive companies that we're invested in, around what they're doing to mitigate that going forwards. And so a lot of the engagement activity you'll see on the environmental side of things has been somewhat underpinned by our understanding of carbon intensity within the portfolio companies, not least of which just in that primary assessment that we're undertaking that Niamh walked you through, but then also recognizing how that evolves through time and how it impacts the overall portfolio carbon intensity framework. So maybe with that then, Niamh, I can pass to you and just we can cover on engagement and proxy voting and then try to give a little bit of perspective on the post-COVID landscape at the out.
Yeah. If we turn to the next slide. The next one again, just in terms of to highlight, Luke will take you through in terms of the proxy voting in relation to equities, but this is a collaborative effort across our three different business units. So it's fixed income, equities, and our quantitative business, whereby we're working together on collaborative engagement on two themes that are key to Goldman Sachs. One is climate transition and the other is inclusive growth in relation to the social factors. So through this process, I think, you know, for example, shareholder proxy voting, other activity within equities has been undertaken for some time, but I think it has only recently been recognized the influence and potential in relation to bondholder engagement with issuers. So this is something that we're very focused on. I would say that within, for example, our credit team, they're primarily focused on credit risk. So the themes that I showed you, they engage with their issuers if they see that a company is underperforming on a particular theme. This is more about positive impact, where we have worked with the two teams. So for example, our quant team have done a slice and dice of data based on the Sustainability Accounting Standards Board. They have basically gone through all of the data on companies reporting in relation to climate transition. They've benchmarked them versus sector peers. Their starting point was, should this company be reporting according to available standards? Is it reporting? Is its peers reporting? And what level of detail are its peers reporting? So it's very much a benchmarking process through which we then came up with a universe of companies that are not disclosing this level of data in relation to carbon risk and climate transition. We then worked as a team to say, okay, in terms of influence, is the better approach, the better entry point via shareholder through the AGM proxy voting, or is it actually in relation, you know, is this issuer a repeat issuer in terms of the debt market, and can we apply our influence there? And from this process, basically, we've identified this universe of companies, and our analysts are reporting that are approaching these companies to encourage them to disclose the necessary data. And I think one of the kind of underlying success points in relation to this program is that when we go in and talk to the programs, it's the analysts, it's the coverage analysts asking them, but also we have done the analysis. We know what their sector peers are doing, and we know that they're not disclosing versus their sector peers. I will come to the social factors, but as I say, we particularly within the current environment in terms of COVID, we're very focused on social. The problem with social is often in relation to the availability of social factors, but we have identified this as our number 2 key theme. And again, we're working with the Quant team as to what frameworks to work with, what kind of indicators we can identify in that process. It's at a more nascent stage than in terms of our climate transition, because we're still looking for the appropriate framework in relation to social factors. Luke, you may want to comment in terms of the proxy voting team and the stewardship team.
Yeah, absolutely. Yeah, so maybe, Marianne, if we can turn to page 18, what we have on page 18 just is a very quick summary, somewhat of what Niamh has already touched on in terms of that top-down engagement effort the stewardship team is undertaking, but then also the fact that it's being complemented very much by that bottom-up research view. And you can see just in terms of the kind of UNPRI engagement rating, we have had a fairly consistent A+ outcome over the last few years. Now, just in terms of how we bring those two perspectives together, what our stewardship team is setting out to achieve is a broad framework that highlights critical objectives for us across our entire book of assets. So I mentioned at the outset, we're voting here on roughly $300 billion of equity assets. We also want the engagement activities we're undertaking with our fixed income portfolio holdings to be consistent with that broader framework. Now, a significant amount of that is focused on better disclosure, but there's also critical areas that we think are going to be crucial for companies' long-term success, such as diversity within businesses and around certain climate risks that will, not least of which, be part of our broader proxy voting framework, but then will also be consistent with how we then push those companies to improve. And so just to give some perspective around, let's take the gender diversity one as a good case in point. Over the last 2 or 3 years, we have had a policy, firstly in the US and now globally, to vote against the chair of the nominating committee for any company that does not have a female representative on their board. Now, for us, we believe that diversity is not just something we should seek for the sake of solving for quota or for trying to drive affirmative action. It's because better and more diverse teams drive better outcomes. What we have to ensure within that is that when companies are looking to improve the diversity across their businesses, that they're doing it in the right way. And so the natural interlinkage here between the research team and our stewardship and proxy voting policies are going to be if companies are actually setting out to achieve diversity for the sake of diversity or in order to lead to a better overall conclusion. If we look at how we've approached that from a proxy standpoint, actually there's a number of instances in the US where we have voted against portfolio companies and we've engaged actively with them and made clear that we'll continue to vote against them or sell down those positions unless we see improvement. What's interesting, and this also ties into the benefit of having that global footprint of Goldman Sachs, is in many of those instances, that also draws us into a quasi-consultancy type relationship with some of the companies we're engaging with, where they will look to us for guidance. They'll come to us for some perspective and expertise on who could be appropriate female members of their board that they could add in, who have the appropriate industry experience. And actually in a number of instances in the US, we have been able to partner with our investment banking colleagues who also cover those companies from a banking perspective in order to give them some perspective on who could be considered potential candidates for those roles and try to get to a better overall conclusion. And we won't go through it in great detail here, but if you were to reference our annual stewardship reports, so our 2019 report is available, our 2020 report is due out in the next couple of weeks, you'll see a very clear picture of how we voted proxy in line with those expectations, both around gender diversity, broader diversity within the businesses, improved disclosure, and then also the broader push for more conscious environmental practice across the businesses that we're investing in.
So if we turn to slide 20, I just wanted to highlight within the current environment, something that we have seen quite strongly since March. I'm on the calls every day with our investment teams on the fixed income side, and I know this is also true in relation to equities, in relation to new issues. And what really became evident as we went into COVID and kind of lockdown in terms of working from home was that the analysts were increasingly raising social issues within their coverage. You know, I mentioned earlier in relation to some recent work we did in relation to buybacks, but also it was in relation to companies' liquidity, but also what they were doing, how they were positioned in relation to their stakeholders, including employees, how they were dealing with employees, but also suppliers. We saw an example of one European food company, for example, that actually did early payment to its most vulnerable suppliers, and other kind of stakeholder groups. We also saw, for example, in the US, some insurance companies which realized that basically their customers were not driving during COVID, and actually, gave their customers rebates in terms of their insurance coverages for autos. So this was very evident during it that, as I say, as part of the regular investment calls, social factors were being raised again and again. So I guess Luke mentioned diversity, and we have made a lot of kind of headway in terms of disclosure on diversity data, in particular in relation to gender diversity. What we soon realized was that there were many companies that have made positive declarations about the value of their employees, suppliers, and communities, but that is being put to the test. And we need to be able to evaluate how companies are positioned in relation to that. Now, I would highlight that one of the key problems here is the availability of data. For example, one of our credit analysts in the US decided to undertake an assessment in terms of racial diversity, and just found that the companies are not disclosing this. I know that when we previously did an evaluation of the data that's available to look at, say, the UN Sustainable Development Goals, we encountered the same issue. So I would say that we're probably, in terms of the spectrum of reporting, we're probably where we were at with climate reporting 5-6 years ago. And we have, as an ESG community, made a lot of advances in terms of climate disclosure, primarily as a result of the Task Force for Climate Disclosure. We're very much hoping, and also we're doing everything we can to partner with other organizations, including some of the standard setters such as SASB and others, that we will come together to identify what are the key social metrics, and then similarly as we've done with climate, and particularly under the umbrella of our inclusive growth, approach the companies and encourage them to disclose this data. So I would say very much in relation to social factors, we see this as kind of the key trend that has emerged from COVID, and we don't see that this will go away. We think this now is basically the kind of a key theme. And I guess the other thing to say in terms of social factors is that we have seen that our analysts themselves have increasingly begun to basically engage with those companies in the consumer sector, because we previously would not have seen those as high impact sector. You often think high impact pharmaceutical or banking or say carbon footprint, whereas it's now recognized, particularly in consumer and customer facing roles, that there's a significant social impact. So we have increased our weighting in terms of social factors, with the caveat in terms of the data. So with that, we are delighted to have been able to illustrate to you our ESG investment process within GSAM, and we'd like to open it to the floor to some questions.
Thank you, Luke and Niamh. Thank you very much. That was very interesting and very comprehensive analysis of what it takes to do ESG. And I think we all agree that it's very much to the credit of the financial industry that we, let's say, have taken on the ESG issues with such an innovative and consequent approach. There is one question outstanding. What do you make of the empirical evidence, especially from Demers et al., that ESG didn't immunize stocks against the COVID-19 market crash?
Yeah, Niamh, maybe let me just jump in on that first, and then by all means add to it. So I saw that same paper, and I think it's fascinating because our perspective, and I'm just taking a step back here, is we are an active manager. We are buying businesses that we are comfortable owning for the long term, and in association with that, are critically assessing the sustainability of practice within those businesses. And what we saw in our portfolios was that focus on ESG, which is a bull market nice to have, became a bear market necessity. Companies that did well through the crisis were, in our opinion, and reflected in our portfolios, those that had sounder ESG practice. Now, there's always going to be other aspects at play that will influence near-term returns. Clearly, just general industry and sector trends do have some impact on that. But we definitely saw, and it's reflected in the outperformance of our strategies through the course of this year, a clear alignment between better quality practice, better long-term alignment to some of those secular growth themes associated with improving social practice and providing environmental solutions to other businesses that would counter that perspective. Now, what I would say, and again, this is my own personal view, is the inherent challenge we have in trying to regress equity performance against ESG factors is you are assuming that the quantitative ESG rating that you're giving to a company is an appropriate categorization. So if you think about that research that was done, what you're implicitly looking at there is ESG scores of companies and regressing that as one of your factors against the returns of the market. And if we go right back to where we started, which was our starting statement that we do not yet believe you can quantitatively assess ESG practice within a business perfectly, then that regression starts to unwind. So rather than saying ESG is not important in determining performance of companies, what I would argue is actually the ability to assess ESG quantitatively that then factors into that regression is more of the challenge. And so again, when we think about the integration of ESG into our process, it is very much underpinned by the qualitative understanding of our analysts that leads us to make those investment decisions. And we see that reflected in the performance of our strategies, very clear alignment between better quality practice and better performance. But it is still very challenging to quantitatively prove that because of the issue around how you rate companies from an ESG standpoint. Niamh, I don't know if there's anything you want to add to that.
Your coverage there was very similar, yeah.
There's another question, actually, this is more of a economic philosophy question. The ESG success depends on the regulatory and social environment that it works in. Is there not a potential competitive advantage for those companies who simply don't recognize those externalities and make a superior profit by ignoring them?
I think we have a very different perspective here, and Niamh will have a view as well, when we consider credit versus equity on this question. And the reason I say that, Sheila, is because if you're an equity investor, and this isn't to say you can't make a quick buck by trying to trade in and out of companies with weak practice and avoiding, or at least being able to own them in the short period of time where they might re-rate before there's some heightened awareness of those challenges. But if you're buying into stocks to own them for the long term, then a huge amount of the value, the intrinsic value in that business sits in the terminal growth years. So if we just think simplistically, most companies that we're going to model on a DCF basis, 60 to even 90% of the intrinsic value will sit more than 5 years out. If our hypothesis here is that unsustainable ESG practice can't exist forever, then actually the impact on intrinsic value of assuming unsustainable practice has to normalize at some point in the future is very significant on that intrinsic value. So it's just to say that if you are a long-term equity investor, you won't be able to predict when these issues come to the fore, but if they do come to the fore, they can be very value erosive. And if you look at, I'm going to use a couple of recent examples, but Norilsk Nickel in Russia, that is a business we've had heightened concerns around for a number of years because of the underspend on waste management. Their capex has typically run $1 billion lower than their peers, and that has been a concern for us, despite all of the output that they would have from an IR perspective that would suggest otherwise. You can't determine when there's going to be an issue, but when that happens, it's going to be very detrimental to share price. Similarly, if you look at a Vale in Brazil, you had some evidence in 2015 there might be some issues with tailing dams. That wasn't necessarily fully reflected in share prices. You saw some concern around ongoing investment in those health and safety procedures. And you also saw some insurance companies low-key pulling back from that type of company because they didn't feel the risk was appropriate. To us as investors, even though we can't predict when there might be another issue, as soon as there is a concern that there could be an issue, that has a meaningful impact on the long-term value we would see in that business. And so then when you do get that issue 12, 18 months ago with the significant tailings dam collapse that happened in Brazil, that's when that downside scenario really plays through.
And
so
just
Niamh,
from, you know, in practice point of view, I would say that is why it's key as an ESG specialist. A key part of our role is to sit with the investment team and agree on the materiality of the factors. And I often say that, you know, we will not put in a theme if the analyst doesn't see it as material, because I want them to take ownership of that theme. So, for example, data and cybersecurity, you know, we've seen it emerge as a risk in terms of a quantifiable risk. We haven't seen any, you know, any significant kind of financial impact as of yet in terms of performance, but I would say it's something that our analysts are very aware of in terms of tracking. But also, for example, conduct risk in relation to banks. We've seen litigation. You know, we saw in US drug pricing, and this was a behavior of an industry that basically, you know, by the behavior of a few players within that industry, it led to drug pricing being an election issue of both candidates in the last US election. And in fact, all the pharmaceutical companies in relation to COVID drug pricing were brought in front of Congress recently to comment as to their strategy. And they've learned their lesson that if you push the boat on these issues, there is a significant risk of regulation in relation to particularly an industry where there's potential harm to consumers. So this, I think, really underscores the fact that materiality is at the heart of everything we do, and our analysts do view the issues they rate and review as material.
Thank you. We have a question from David Crossier. And I think it refers back to that slide where you were talking about the utility score weightings. How is it that your scores put much bigger emphasis on E 70% rather than S 10 and G?
Yeah. Thank you for highlighting that. That was the utility company. If this was a pharmaceutical company, a pharmaceutical would have 40–50%. Off the top of my head, I believe that's what would have it in terms of social factor, because the focus would be on the consumer. So this was utility, where we regard the E in terms of stranded assets, in terms of the climate transition, as the most material. I would say for banks, we would have a very high weighting within the governance, because it's focused on customer needs and other kind of conduct litigation issues. So I'm glad you highlighted that was a particular sector. We have different weights for every sector.
Good. But it actually leads to another question. You've identified and done very obviously significant analysis and research on ESG. My question is, what has been the client response? Have you seen differences between institutional and retail, or is there a different importance put on E versus S versus G? How would you describe your client response to the ESG efforts?
Luke's on the client side, so I will let him.
Yeah, of course.
But just to say that, I mean, as someone in ESG, I would say climate has become the theme in the last 2–3 years. And I would also say that among our clients and the key consideration, and I highlighted at the end of our presentation that the social factors, we do think that this will be the kind of second key area of focus. But as I say, Luke's on the client side, so I'll hand over to him.
Sheila, it's a very good question. I would say for the most part, there was a legacy awareness of governance. People recognize the importance of governance within their investment decision-making process. I would say in the last 5 to 7 years, the focus has then been very much elevated onto environmental considerations. So onto climate change related issues, carbon intensity, and understanding that within your broader portfolios. The social factors, and Niamh made this point, the social factors have always been a little bit under the radar. Not that they weren't important, in many cases they're critical, but outside of just kind of broad understanding of supply chain management and some of the labor practices, some of the broader issues related to social practice have not necessarily been that well assessed. And part of the issue there is they are oftentimes quite qualitative criteria, right? How can you quantify corporate culture? It's a very difficult thing to do. And so as much as people think increasingly that those are very relevant factors that we should be considering, they're also very challenging factors to get your heads around unless you have a detailed understanding of that business that spans many years of covering those stocks or credits. Now, I would say that so that's very much kind of around ESG integration. There is also another aspect to this, which is something we've identified through our core ESG work, which is there are opportunities that are born out of companies that are able to solve other environmental and social issues for companies. So if you think about the solution providers to certain environmental issues or the solution providers to certain social issues, if you are a business that is able to innovate in that space and provide something new and unique that can alleviate the challenges that other companies are facing from their investors or from their customers, they're actually very keen to pay up for that type of solution. And so there is a growth opportunity related to that. It's a very different type of investment discussion, right? ESG, as we've said, is primarily here around risk mitigation, understanding the risk profile of the business and how sustainable that business can be into the future. But if you can identify those companies that are aligned to those secular growth themes related to environmental solutions and social solutions, then actually there's a very interesting opportunity there as well. And I think in terms of client appetite, that is an area we have started to see much more obvious focus. So people carving out some portion of their traditional core equity portfolio to invest into explicitly environmental equity solution providers, where you see a tailwind for growth for those companies underpinned by the shifting regulatory environment, underpinned by the Green Deal that the EU has announced, and the fact that, as I mentioned, just in a world where the cost of carbon and unsustainable environmental practices going ever higher, companies are more and more willing to pay up for those types of solutions that can alleviate the issue for them.
And that actually leads to another point that we are seeing, within fixed income, as I say, we have the lens of credit risk primarily, but because of our clients' interests on positive impact, and that's why we're focused on things like inclusive growth. We obviously are also looking at how we can map performance on these issues to the Sustainable Development Goals. Again, probably one of the challenges there, because what you're trying to do is move some of these factors from where carbon was previously to full disclosure so we can evaluate. I know in relation to the SDGs, as they're known, these are the 17 Sustainable Development Goals that basically when you look at things like jobs or other factors, companies aren't even reporting, some of them, the number of employees, not to mind whether they have ILO standards or effective health and safety programs. So again, this is an industry using its influence to kind of try to move the companies in terms of reporting. And I think that's led also by regulation, as we've seen at the EU level, and also by examples of competitive best practice where companies have really embraced sustainability at the core of their business. So, there's a lot of exciting developments in that area, and we do believe that our clients will want to measure not just financial performance, but also the performance as a result of their investment in relation to, say, emissions reducing or other positive social impacts.
Good. Just one last question. there used to be an argument about sin stocks, because so many clients didn't want to buy tobacco, gambling, alcohol, that those actually became better value. And I know that in your approach, you combine both fundamentals and ESG. How would you balance the sort of the valuation versus the ESG component? Do you see any, I don't know, sin stock premium being or discount being generated?
It's a good question. So I think the key part there is just time frame for investment. As we said, if you feel that there is a logical rationale for why companies in a certain industry will suffer long-term harm, then that makes it very hard for us to invest in those types of stocks, right? So if you let's just take upstream oil and gas space at the moment, right? That is going to be an area that we think comes under structural decline as we get a shift towards electronification. EV penetration continues to increase. If you think about the renewable space and you think about the demand for coal, that's already been surpassed by, you think, renewable cost curve, which is now already more cost efficient to produce than if you think about traditional fossil fuel based power generation processes. And so when you're a long-term investor, the idea that, oh, there's opportunity for these companies to do well over time, I think is a little bit over exaggerated, because they're going to face significant headwinds as you get that economic transition away from some of those traditional processes. It's not to say there can't be selective winners, right? So let's take again oil and gas. In a world that does aggressively transition away from your traditional fossil fuel based solutions, but maybe moves a little bit too quickly to the point where CapEx into an investment into that space is a little bit slower than, is a little bit lower than we would have thought otherwise, then maybe there is an opportunity for a little bit of a spike in oil prices if you get an undersupply relative to the ongoing demand. But over a long period of time, it seems very hard for us to justify that that's a good place to be invested. We'd much rather own the renewable utility than the traditional coal-powered utility. We'd much rather own the clean fuel business that can take share away from traditional petrol or diesel engine. We'd much rather own EV over traditional internal combustion engine. So it's just something that is hard to justify on a longer term basis.
And interestingly, we've seen an indirect impact of that. For example, one of the key risks in relation to banks, in addition to conduct risk, is banks now have to disclose in terms of their loans portfolio a lot more details in terms of their funding of fossil fuels. So, you know, if you're previously, when you were talking to Canadian banks, you knew they were exposed to oil sands, but you didn't know to what extent in terms of their balance sheet. Now they have to disclose that. So basically, you know, from our view, it's a risk in terms of stranded assets, some of these fossil fuels. So it's interesting to kind of see how this has impact on other sectors. As I say, banks is one key area where many of them now have coal and other fossil fuel policies where they will say they will not invest in greenfield investments in this space because of the risk.
Thank you very much. And there's other questions, and I think we could discuss this for a significant amount of time, but we do have to draw a line given our time limits. I'd like to thank both Niamh and Luke for the most interesting presentation, and wish for the sake of the planet, we wish you all the best. I would like to just highlight that we have an upcoming seminar on the test of crisis. Core infrastructure is essential, and it's on the 15th of September. It'll be a very interesting presentation from JP Morgan representative. So please look at our events calendar and sign up. But in the meantime, I'd like to thank again Niamh and Luke for the most interesting presentation, and especially to the participants who benefited from it. Thank you again.
Thank you for having us.
Thank you, guys.